All right, now to our next conversation. South Africa's Reserve Bank has tightened policy 5 times in a row with the magnitude of rate hikes not seen in 2 decades. That hasn't done much to help the rand. Now, at this point, let's talk to Matt Kindigan now, practice leader, Sub-Saharan Africa Front of View. Great to have you, Matt.
Hi, Larry. Good to see you today.
Yeah, so Matt, it's another hike, and it's like hike season everywhere at this point. Did you expect it from South Africa?
Yes, is the short answer. So we were expecting the hike by the South African Reserve Bank, and this is because the Reserve Bank has said in the past that it is keen to raise interest rates to try to tame inflation, but also protect the value of the rand or prevent instability in the rand. And we are seeing this across other parts of the world and in sub-Saharan Africa. So we certainly were expecting this, although the very sort of large increase in rates was not quite expected. But what this does show us is that we are likely to see further interest rate hikes in South Africa going forwards. And this is as a result of regional and global factors, or national and global factors. So firstly, we are going to see a strengthening US dollar. We have seen tighter monetary policy in the US and the Eurozone. You know, the most recent increase in interest rates by the European Central Bank has shown that there will be pressure on capital flowing out of South Africa. And so we certainly do expect to see the South African Reserve Bank continue to raise interest rates. And there's also the issue of inflation. So as inflation remains well above the Reserve Bank's upper target limit of 6%, there will also be extra pressure on them to try and curtail the inflationary effects that the country is seeing.
And how do you see this impacting, the manufacturing sector in sub-Saharan Africa? Because everyone is tightening at this point.
Yeah. So from a manufacturing perspective, it certainly is not great because many countries, including in South Africa, we've seen relatively cheap credit over the last 24 months or since the beginning of the pandemic. And this is because in an attempt to stimulate the economy, the South African Reserve Bank slashed rates to the lowest level on record. And as a result, businesses, households, including in the manufacturing industries, were able to borrow at much lower rates. And we did see what we were expecting to see this continue for a longer period of time. So we could see businesses begin to delay or withhold investments. We could see them postpone investments into equipment, and so this could be, relatively bad for the manufacturing industries.
Quite interesting. And how do you see higher interest rates, affecting the outlook for the rand? We've seen, rate hikes in Nigeria. The naira is not doing any better, and it looks like it's not, working for the rand also.
Yes. So what I would say is that we'd probably see even more aggressive depreciation or more substantial depreciation of the rand in the absence of tighter monetary policy taken by the South African Reserve Bank. Our view is that we are going to see continued depreciation of the rand through the rest of this year and into next year. And as a result, the South African Reserve Bank will be forced to intervene. So by raising rates. So we do expect to see there to be some benefit for the value of the rand or the stability. But what the South African Reserve Bank can't control for is things like the country's trade balance, which is going to be turning more negative. And this is because we expect export revenues to soften over the next year or so. Some of South Africa's key commodity exports, coal, iron ore, and gold, to an extent, are expected to continue to soften as the global economy slows, mainly led by a recession in the US and likely in Europe as well. But we're going to see persistently high oil prices, which will mean that the fuel import bill for the country will remain very high. So we're going to see weaker export revenues, very high-priced imports, and this will put pressure on the currency. So more depreciation, but South African Reserve Bank interventions will prevent even more severe depreciation, in our view.
Right. And do you expect the economy more broadly to be affected by these rate hikes?
Yeah. So as we talked about just now about manufacturing, credit growth is or has been one of the lifelines that the South African economy has seen over the last 2 years. So despite quite weak domestic economic fundamentals, very low interest rates have encouraged consumers to spend and invest and purchase products and services that they may not have committed to if interest rates were higher. We've also seen the government's debt servicing bill actually remain a lot lower than we were previously expecting as well. And so this has meant that the government has avoided some of the most severe spending cuts and tax increases that we were previously expecting. So what we are going to see is some of these drivers, so credit growth as a driver of investment and spending in the market, begin to taper off. And this is not great news for the South African economy because the other drivers of growth, such as exports, tourism revenues, consumer spending, are already, are already quite weak in the market. So we would say it is a contributing factor to a slightly more pessimistic growth view for the economy. We're now forecasting growth of about 2.2% for 2022, and this is down from about 2.7%. And high interest rates have been a major contributing factor to this downgraded growth view for this year.
Yeah, and looking at, sub-Saharan Africa at this point, do you think, the economies here should be looking at hiking rates? Because there is that concern that the rate hikes are not taming inflation at this point.
Yeah, so there's this quite a large debate at the moment about whether interest rate hikes will curtail inflation, because arguably the inflationary spike that we're seeing at the moment is supply driven. So largely a result of higher commodity prices, fuel prices, agriculture commodity prices. That all stems from the conflict in Ukraine. And there's very little that a reserve bank or a central bank can do to influence these factors. There is some argument that in markets where we are seeing quite strong economic growth and improving economic conditions, Angola is one. In Kenya, we were also seeing very upbeat economic performance. To an extent, interest rate hikes can soften demand growth, and this does discourage companies from raising prices. What it also does is it provides a bit of a cushion for the currencies in these markets, and this does mean that the price of imported products, again, is tamed a bit as a result of improving currency stability. So our view is that rising interest rates are probably not going to be as effective as they would if we weren't seeing this historic spike in commodity prices, but they will probably, to a certain extent, help to solve the problem.
Yeah, well, we'll be looking out to see how the sub-Saharan African inflation actually tapers at some point. Hopefully that happens with all the rate hikes we're seeing at this point. Thank you so much, Matt Kindig, Practice Leader, Sub-Saharan Africa, Front of You. It was great having you.
Thanks, my pleasure.